Hi everybody, welcome back to 10 Minutes with Griffin. For today's episode 135, we're going to just quickly walk through a recent private letter ruling that deals with investment advisor fees in an annuity contract. This is a issue that might have some relevance, especially for those of you who are in the life insurance and annuity world, or those of you who are clients who have investments in this world, especially with the proliferation of more private placement and directed types of annuity and life insurance contracts and policies. So we'll dive into the ins and outs of those briefly and in the context of this ruling and why this ruling is ultimately important, even if it's duplicative of advice that already exists. Now, as always, this presentation is not intended to substitute for legal or tax advice, and is provided for educational purposes only. Now, what did this private letter ruling do? Well, it provides helpful guidance for investment advisors who might be guiding clients who own a privately placed annuity or life insurance contract regarding their investment options within that contract or that wrapper. Now, ultimately what this does is it exempts the client from being taxed on any of those fees that are paid directly from the contract or the cash value to the investment advisor. Otherwise, such fees could be characterized as amounts that are received as an annuity or not as an annuity, but otherwise taxable to the client, and those are subject to income tax in part or in full under Code Section 72. So, what happened under this private letter ruling? Well, first off, I want you to keep in mind, I've mentioned this on a number of presentations where I cover private letter rulings, that this really just applies to the taxpayer who requested the ruling. And while it's helpful advice, it's not binding advice for anybody else who wants to mirror this transaction. But that being said, what happened is we had a life insurance company who issues annuity contracts that had internal investment options, which kind of fell into three camps. You had a variable investment option, you had a fixed indexed investment option, or a hybrid of the two. So what happened is that the owner who purchased the annuity contract could also end up in a separate contract with an investment advisor who can guide them through the three investment choices and kind of guide the management of investments based on those choices and what the portfolio investments were in each of those choices. Now, in exchange for their advice, the investment advisor was allowed to receive a fee that didn't exceed 1.5% of the cash value of the annuity. So notably, that was the only compensation the investment advisor could get here. There was no commission on the sale of the annuity contract, so the investment advisor wasn't acting in a sales role or selling the annuity necessarily to the client, but once the client purchased the annuity, then the investment advisor was instead getting a fee for assets under management within the annuity contract itself. Now, what was allowed, and this is kind of ancillary, was that the investment advisor could receive a wholesaling fee or marketing allowance from the life insurance company in this case. So ultimately, what the owner would do is they direct the fees based on the terms of the contract with the investment advisor. So the investment advisor was free to agree with the owner of the annuity on a fee of up to 1.5% of the cash value, but it couldn't exceed that amount. And the owner didn't pay the fees directly. Instead, the life insurance company who was in charge of the annuity would pay that fee to the investment advisor at the direction of the owner, directly from the cash value of the annuity contract. So, diving into the tax analysis, Code Section 72 is pretty complex when we get into dealing with annuities. There's a lot of weird areas and gray areas, and I've touched on some of them with MECs and other things and IRAs. So, down the road, we're going to get more comprehensive with Section 72, but generally this breaks any annuity down into two camps. One, you have an amount that's received as an annuity, generally after the annuity start date and based on a level schedule. And it's taxed in part as a distribution of income on the contract, which is taxable, and as a return of investment in the contract, which is not taxable. Now, any amount in excess of the amount that's received as an annuity, or any amount received prior to the annuity start date, would typically be classified as an amount not received as an annuity. And that would be really kind of taxed, sometimes according to source, maybe as a tax-free return of investment if you get FIFO treatment, or as a distribution first of cash value before investment is recovered. If you have a LIFO type of analysis, you'd see LIFO with a MEC, but FIFO usually with a life insurance policy that's not a MEC. It may even be fully taxable if it's received after the annuity start date as well. And it's important to note too that there's an additional 10% premature distribution penalty that could apply if, for example, the annuitant has not yet reached the age of 59 and a half. Now, what was at issue here is not necessarily an amount received as an annuity, but instead the question of whether or not there was an amount that wasn't received as an annuity, requiring you to dip into these various analyses, as well as the dipping into whether the client had reached the age of 59 and a half and might be subject to that premature distribution penalty. So, really what this was a question of sourcing. Could the IRS treat the investment advisor fees as if they had been first distributed out of cash value to the owner slash annuitant and then paid to the investment advisor, or would the IRS consider the fact that these were paid directly to the investment advisor out of cash value to be really an internal investment fee, even though it's contracted for by the owner, but nonetheless it would be a fee that isn't treated as if it's distributed to the owner first before payment, and ultimately it was a question of control, since it was the owner of the annuity who was directing the payment of that fee. And what the IRS ultimately determined is that it wouldn't be treated as an amount not received as an annuity, which doesn't make sense on its face, but really the meaning of that is that it's not ultimately taxable to the owner slash annuitant, even though it's paid from cash value and even though it's being paid at the direction of the annuitant. Now, it's important to note that even though this was a favorable conclusion, there are some limitations ultimately here. One, the ruling kind of implied that they were really just looking at this 1.5% investment advice fee, and any amounts that exceeded that could end up being treated as amounts not received as an annuity, which would be taxable. In addition, any fees that were paid from the annuity's cash value for any purpose other than investment advice could also ultimately be treated as taxable amounts not received as an annuity. So if you're going to follow this private letter ruling, you have to stick to the very strict interpretation under these facts. Now, this is an area that's pretty well settled. There's a number of carriers out there and a number of companies that offer these private placement type of life insurance policies and annuity contracts and directed contracts. So this isn't necessarily a surprise. This is really just kind of confirming what a lot of advisors already know in terms of what advice they can give and where they can source their fees from when it comes to looking at both the client's overall personally owned investment portfolio when balanced with the portfolio that's housed within the annuity or life insurance contract. But it's important to be cognizant of the source of those fees, especially since they're contracted for and directed by the client themselves. So, for example, if you had a client paying a fat fee out of pocket for their assets under management, some of which were managed assets in an annuity or life insurance contract, you might not get the benefit of this guidance, which isn't binding anyway, but at the same time, the big question is, that the client paying those fees directly out of pocket may be treated as at worst, an amount that's been paid from the annuity to the client first, and at best, maybe as an investment in the annuity contract itself. So either way, there's some weird technical rules that come into play here, and it helps to kind of keep this in mind in the back of your head and really kind of dig into Code Section 72 if you're somebody giving advice in this area or if you're a client dealing with fees in this area. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. And thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.